Imagine waking up to a global economic landscape that's been forever altered. A staggering $25 trillion has vanished into thin air, leaving experts stunned and investors scrambling for answers. This isn't some fictional plot twist, it's the harsh reality we're faced with today. On October 1, 2020, a seismic shift occurred in the global economy, sending shockwaves across financial markets worldwide. The culprit behind this unprecedented phenomenon was not a natural disaster or a pandemic, but rather the sudden and unexpected transformation of a specific asset class, the global bond market. In an instant, trillions of dollars worth of bonds were reclassified from their traditional status as risk-free investments to increasingly uncertain assets. This seismic shift sent markets into freefall, causing widespread panic among investors who had placed their trust in these previously low-risk investments. The sheer scale of this event is almost impossible to comprehend. To put it into perspective, the $25 trillion that vanished represents a staggering 35% of global GDP. It's equivalent to wiping out the entire economy of Germany or the United Kingdom, and still having enough left over to purchase every single bond on the planet. As markets struggled to come to terms with this new reality, some savvy investors saw an opportunity amidst the chaos. With the sudden collapse in value, these astute observers began snapping up bonds at fire sale prices, betting that the market would eventually stabilize and values would rebound. But what if we told you there's more to this story? What if we revealed a hidden pattern underlying this $25 trillion shift, one that could potentially reveal new profit opportunities for investors willing to take calculated risks in these uncertain times? The financial world was sent reeling on October 19, 2020, as a seismic shift rocked the global economy. The event that triggered this economic earthquake wasn't a natural disaster or a major geopolitical conflict, but rather a series of trades placed by unknown entities in the options market. In a matter of hours, these massive bets against the stock market caused a ripple effect that would ultimately wipe out over $25 trillion from the world's financial markets. To put this staggering figure into perspective, consider this: $25 trillion is roughly equivalent to 35% of global GDP, or more than twice the total value of the U.S. economy. This was no ordinary correction. It was an unprecedented collapse that left investors reeling and experts scrambling for answers. As news spread like wildfire across financial markets, trading on Wall Street came to a grinding halt as stocks plummeted by as much as 7% in just minutes. As the dust settled, one thing became clear: the global economy had been thrown into chaos. Central banks, usually quick to act in times of crisis, were caught off guard and struggled to respond effectively. Meanwhile, market volatility skyrocketed, with the VIX index, a measure of fear and uncertainty among traders, spiking to levels not seen since the 2008 financial crisis. In the aftermath of this shocking event, questions swirled about who or what was behind these massive trades. Theories ranged from rogue hedge funds to state-backed actors manipulating global markets for their own gain. Whatever the truth may be, one thing is certain: this $25 trillion shift marked a turning point in the global economy, and investors would do well to pay attention to its implications. The sudden disappearance of $25 trillion from the global economy sent shockwaves around the world. This unprecedented event has left economists and experts stunned, scrambling to understand its causes and implications. The affected sectors are varied: markets plummeted, currencies fluctuated wildly, and the usual metrics no longer applied. At its core, this shift was driven by a massive withdrawal of investment from traditional assets like stocks, bonds, and commodities. A staggering $15 trillion vanished from the global stock market alone, wiping out nearly 20% of its value in a single day. The subsequent market crash saw losses mount, with investors watching helplessly as their portfolios hemorrhaged millions. Central banks and governments worldwide have been forced to intervene, injecting billions into the economy to stabilize markets and prevent further catastrophe. The Bank of England's emergency measures, for instance, involved injecting £100 billion into the British economy within a matter of hours. Similar interventions were carried out by other major central banks. The ripple effects of this shift are being felt across sectors, from small businesses struggling to access credit to multinational corporations scrambling to adjust their financial projections. In some cases, companies have reported losses in excess of $1 billion, while others have seen their valuations halved overnight. Economists and experts point to various factors contributing to this shift, including rising global tensions, trade wars, and climate change concerns. While the exact causes are still being debated, one thing is clear: the world has entered a new economic reality where nothing seems certain or predictable anymore. As the news sank in, economists and investors alike were left grasping for answers. The $25 trillion that had vanished was not just a number, but a symptom of a far more complex issue. The shift, known as the Global Economic Shift, or GS, was characterized by a sudden revaluation of assets worldwide. According to data from the Bank for International Settlements, over 70% of global debt is now denominated in foreign currencies, making it vulnerable to exchange rate fluctuations. This has led to a surge in defaults and write-downs across various industries, with notable examples including China's Evergrande Group and Argentina's sovereign bonds. The GES has also exposed the fragile nature of global supply chains, as countries scramble to adjust their trade balances and mitigate the impact on their economies. For instance, Germany's export-driven economy is now facing significant headwinds due to a depreciating euro, while Japan's export-oriented sector is benefiting from a relatively stable yen. As governments and central banks rush to respond to this new reality, investors are being forced to reevaluate their strategies. Hedge funds and private equity firms are scrambling to adapt to the changing landscape, with many shifting their focus towards emerging markets and alternative assets. Some experts, like economist Nouriel Roubini, have warned of a potential global recession triggered by the GES. Others, such as investment guru Ray Dalio, believe that this shift presents opportunities for those willing to take calculated risks. The truth is, no one knows exactly what the long-term implications will be, but one thing is certain: the status quo has been upended. As the world grappled with the aftermath of that fateful October night in 2020, a peculiar phenomenon began to emerge. The global economy, which had been held together by a delicate balance of monetary policies and international trade agreements, was on the brink of collapse. It was as if the very fabric of the financial system had been torn apart, leaving behind a chasm of uncertainty that seemed impossible to bridge. The disappearance of $25 trillion from the global economy sent shockwaves around the world, with economists and policymakers scrambling to make sense of it all. Some pointed fingers at the sudden withdrawal of liquidity by central banks, while others blamed the increasing volatility in the markets. But one thing was certain: this was no ordinary economic downturn. As the dust settled, a new narrative began to take shape. The World Bank reported that over 35% of global GDP had vanished overnight, plunging millions into poverty and leaving countless businesses on the brink of collapse. Even more astonishingly, the International Monetary Fund revealed that nearly $10 trillion of that sum was lost in just a few short weeks. Against this backdrop of chaos, a small group of entrepreneurs began to emerge from the shadows. These were individuals who had spent years studying the intricacies of global finance and international trade agreements. They saw the writing on the wall: with traditional economic models crumbling, new opportunities for profit would arise. And they were determined to capitalize on them. One such individual was renowned economist, Martin Feldstein, who warned that the old rules no longer apply. He argued that the current crisis presented a unique chance for investors to adapt and thrive in a rapidly changing world. As the experts debated the merits of their proposals, one thing became clear: only those who could navigate this treacherous new landscape would emerge unscathed. As we've shown you in this video, the $25 trillion shift was not just a random event. It was a symptom of a larger problem: the inherent fragility of our global financial system. The sudden loss of nearly half of the world's wealth had far-reaching